Stock futures there are down big. We saw this on Friday as well. We talked about options. Guggenheim, I sent you this note yesterday. Guggenheim out with a note saying that if the S&P 500 cannot hold its 200-day moving average or break above that 200-day moving average, then they believe, and that's what we're circling right now, we're pretty much on that 200-day and that downtrend. If we cannot break above that, the downtrend is still intact, and it could be a rough fall. What do you say?
Well, so it's a great point. That chart that you sent over from Guggenheim was actually true, and I agree with it. But to a certain extent, when you talk about the bear market rally, which everyone's talking about, there's a little bit of art and a little bit of science. If you talk about the move from June 15th, we've seen a sensational move in the S&P 500. But what's fascinating, Sully, is that we saw less than 20 trading days from that mid-June low, from the 50-day moving average all the way up to the 200-day moving average, where last Tuesday it went up and kissed that S&P 500 at 4320. Now we are seeing a retracement here. And yes, this morning, the S&P 500 is down over 1%. We're seeing the VIX elevate back up to over 23. But I actually think this is quite healthy, Sully. That parabolic move we saw in oversold conditions, I think now we have a little bit of opportunity to back and fill. It's an old pit term we use in the Chicago Board of Trade, but back and fill is actually quite healthy. And I do agree with the fact that we need to overtake the 200-day moving average, but nonetheless, it's a process here, Sully. We are so used to the velocity that's been injected into the marketplace in 2022, we're becoming impatient, and everyone's arguing, is it a bear market rally, or do we actually have footing in stocks again?
Well, I guess a lot depends on your time frame, right, Jeff? I mean, for your clients at Sanctuary that are looking for 10 years out, you're going to have a very different strategy than if somebody's saying, Jeff, what's going to happen next week?
Well, you're absolutely right, and that's the conversation I had with a ton of Sanctuary advisors. Should we reposition? Should we be tax loss harvesting? Should we be allocating here? Because we did go to cash heavily in the first and second quarter. So right now, right here is an opportunity. As you see the S&P 500, the air was really thin, so think about it. When we saw that move above 4,300, we talked about how thin that air was in the S&P 500. Now it's back under 4,200. We're all awaiting the Fed this week, so there's going to be continued volatility, and that's certainly represented. But if you look at the NASDAQ 100 lens, that's a little bit different lens. You know, you actually saw it go from the lows in mid-June back above. Technically, it was a bull market because it went back up 20%. So there's a lot of different lenses to look through here. I think this is all about this midterm election year. This is all about the volatility we have to embrace instead of running away from. So we look at quality names. We look at equal weight in our portfolios. Look at some of the airlines. You've seen these airlines year to date being beaten up. There's opportunity across the board as we continue to see dispersion from sector to sector, Sully.
Yeah. Well, you know what? I was in O'Hare recently, and I thought about you, Jeff, as a Chicago guy, because I don't think I've ever seen more people in. Yeah, no, I was running to catch a flight because my previous flight was delayed. I don't think I've ever seen more people in O'Hare, and that says something. If there is a consumer recession, it sure as heck ain't at O'Hare.
No, you're absolutely right. And I think when I travel the country, I am seeing more and more activity. So I'm cautiously optimistic. I remain cautiously optimistic. But this earnings season, we're not giving enough appreciation to the earnings season. We talk about all the different names. Certainly the bar has been lowered, but we have seen a great earnings season. And that goes back to the Fed. Right now, the CME Fed Watch tool is talking about it's kind of a coin toss between 50 basis points or 75 basis points. But there's a lot of time between now and then.